before we do that, stock of the day, Myer, the retailer, out with its full year result, net profit up 16.5%, topping guidance with full year sales gaining 12.5%, and it's paying shareholders a 2.5 cent dividend. In fact, posting its best start to a new year since 2006, and the company is saying it's well placed to capitalise on the year ahead, despite the uncertain economic outlook, but it has declined to put a figure on that statement. So, Mathan, Myer, it is the perennial sort of struggler in that space, isn't it? So, and I also note that, in fact, Solomon Lew from Premier Investments actually recently upped his stake to around 22% in the company. So, how do you look at it?
Yeah, this is the classic textbook of retail going wrong, and then they got a pretty decent management change, and they've actually done well in a really bad sector. So it is an interesting thematic. Myer was the case study of everything that can go wrong when online businesses come and kill you, and that's what happened. But then management went in, cleaned it up. I have to give credit to management where it's due, and they've actually done quite well for what it is. They've done quite well on the online side of things, and bringing in brands that they're dominated by them, and that's all worked well. It's doing well, but look, it's a tough sector, and the last couple of years you've been given as much handouts as you're ever going to get, and retail has numbers are substantially boosted by it, and Myers benefited out of that. If you look at the chart over the last 5-6 years, around these levels, that's the peak. The multiple looks okay because when it gets to these kind of peaks, analysts get overly excited and assume that they keep pulling out these numbers, which they can't. So it's running as good as it can be. It's paying around, at these prices, it's paying what, 2.5%, 3% yield. So when you got bond yields where they are, it just doesn't play as a yield story. So you're really buying a growth story. I don't think this is a growth story, so I just don't see why you're going to be there. It's a cyclical. So when the cycle turns, it'll get hit just like everyone else. It's been run well, but it's just in a bad area, and I just don't see the growth, especially in the consumer side of things over the next 12 months. So it's one to avoid.
Okay, Mark.
Yeah, pretty opportune time for them to report, really. I think last month's retail sales numbers were a record, 34.6 billion. And a lot of that was in those small, department stores. I think was the best, the biggest uplift within that retail sales number. So they've certainly had tailwinds behind them. It is definitely cyclical, as I said before. We're sort of more looking forward towards adding more non-cyclicals to the portfolio. Look, and I think Premier Investments obviously upped their stake in this, and it's I think it's got better stats overall, and probably a little bit more diversified as well. So straight away, there's another preference. If you wanted to have exposure to this, there's a better option. Just first came off the rank. My preferences would be more super retail or Nick Scali probably in this space. Despite the fact that it was more the larger household items that have been suffering in the retail numbers of late. The return on equity you can't really argue with something like Nick Scali, and they've added a whole heap of stores via the Plush acquisition as well. But no, it's not really a sector we're looking to be particularly overweight in. That's for sure. And but look, credit to them, as Mathan said, management have done a pretty good job. It's their best result since sort of 2018, and look, well done to them. But you can get far better yield, lower PEs, and better average return on equity within the space. And I'd probably be slightly underweight this space anyway, so it's probably an avoid for me as well.